And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show this morning. It's the second best day of the week, of course. That means Michael Lebowitz is joining this morning. We've got a lot to get into after yesterday, of course. Yesterday was also, the start of kind of the big kind of mega cap earnings with Microsoft, Meta, and Tesla yesterday. We'll kind of just touch on those this morning here real quick. Also, the Fed met yesterday, and no big surprise, no change to rates, but got some interesting comments out of that to talk about. So, we'll kind of get into all that this morning. Futures for the markets are pointing higher this morning after that announcement yesterday. So markets will be trading up here just a little bit at the open. And of course, yesterday the market had actually touched an all-time high. We actually hit 7,000 yesterday early in kind of the market trade. We kind of faded off going into the Fed meeting, kind of uncertainty about what was going to be announced, and then markets kind of just stayed flat after that meeting. So again, it was kind of a nonchalant day yesterday, but again, we'll kind of see how the markets play out this morning. But just real quick, just touching on Microsoft and Meta, the kind of very interesting reports and responses to those stocks, following their announcements yesterday. Microsoft reported really much better than expected earnings and revenue really across the board. However, the stock is trading down about 7% this morning because their cloud growth, their Azure cloud growth, was only at 39% growth. 39% growth. Okay, but that was disappointing and apparently worth the 7% discount on the stock this morning because the estimates range from 38.9 to 39.4. So again, 0.4% growth rate difference in Azure growth, and we're going to discount the stock by 7%. Probably going to be a good buying opportunity here sooner than later because of that. But earnings growth, revenue growth across the board was really, really strong. Meta, on the other hand, built out just some great numbers yesterday across the board. Big beat. Stock's going to trade up about 8% this morning. Outlook for CapEx and for kind of their shift from their metaverse to AI is well underway, and that's starting to show some gains there. So stock's going to trade up pretty sharply this morning on that as well. So again, kind of that story remains in the AI space is that there's still a lot of CapEx, right? That didn't change yesterday. CapEx outlooks were pretty strong for both companies, but also the revenue growth from that is still very much in place. So again, a lot of the concerns about revenue growth slowing, those type of things, really not the case. The earnings beat, like for instance, Microsoft beat their revenue growth by $1. So it's just the expectations by a full $1. So again, very, very strong there. Valuations are getting very cheap for these companies, even though they're kind of in that growth sector of the markets. But again, we'll see how these stocks have been under pressure lately. Microsoft's been under pressure. Stock's going to trade back down to where it was about 4 sessions ago. The stock had a big rally going into earnings. It's just going to give up that rally today. Meta's been recovering and is going to have a nice day today. So again, a little bit of an offset in the in kind of the technology communication sector between those two companies. But today, after the bell, we're going to get Apple. So Apple is going to be reporting, and again, kind of all eyes are going to be on growth, AI potential. What are they going to be doing with AI? But really, kind of growth of the iPhones, that type of thing will be big for Apple. So we'll see what that says tomorrow, because that'll also kind of play into this kind of market trade that we'll see over the next few days. Because again, it's just a function. Those companies have such a large weight in the S&P 500 index, they're going to move the whole market in general. Now, next week, we're going to get Google, and then once we start getting further into February, we'll eventually get NVIDIA. So we still have a couple of big players out there still in reference to kind of this AI trade and what all this is going to kind of mean. But with that, let's talk a little bit about the markets yesterday. Here's what you need to know before the bell. Futures are going to trade a little bit higher. Again, we're really struggling with this kind of 7,000 big round kind of psychological cap for the index. We'll see if we can get through it today. We are triggering back onto a momentum buy signal like we talked about yesterday. The market's not really overbought here to any type of extreme at the moment. So again, there's still kind of this general push higher. We'll see if the markets can open up today. Right now, the implied Dow opens up about 50 points. The S&P is trading up about 15. The Nasdaq's up about 67 as we're talking right now. So again, futures are pointing higher. So we're going to try to come out of the gate this morning and start to push back up towards that 7,000, see if we can clip through that. If the markets can break above 7,000, again, that's just, there's no resistance here technically because we haven't ever been above 7,000. So it's just kind of this big round psychological number for the markets. If the markets can get through that, if they can clear that 7,000 level, then you've got kind of a clear shot on looking at kind of a Fibonacci extension up to about 7,100. So that move could occur pretty quickly if we should get up through that. Now, a couple of problems here that just from a risk management standpoint, there's a lot of speculation coming in the markets. Margin debt, as an example, the 8-month rate of change has been screaming higher lately. So in other words, investors are just piling into leverage right now to chase pretty much in any asset that's moving higher. Of course, we've seen this in the metals, we've seen it in the miners, we've seen it in the markets, we've seen it kind of all over the place. So we're seeing a lot of this kind of leverage and speculation pulling into the markets. And again, that's good. Increases in leverage is good because that's additional buying power for the market. So that continues to push these asset prices higher. The problem is it also works in reverse. So if something happens that reverses any of these trades, the unwinding of that leverage could be pretty sharp. So again, when you just kind of look at markets in general, very bullish. Trends are good. There's really nothing overarching to be concerned about at all. But it's just something that, as we talk about a lot, just kind of keep a watch on your risk levels. Just make sure you're taking some profits, rebalancing your portfolio kind of on a regular basis, just kind of doing that maintenance, because eventually we're going to get a reversal in the markets for whatever reason, and it could be 3 months from now, it could be a year from now, but eventually we'll get that reversal, and you just want to make sure that you're kind of in a position for that correction when it occurs. So again, and again, we've talked about rotations in markets, those type of things. There's some assets that are out there that have been underperforming as of late. For instance, we actually had talked about previously that one of the kind of interesting areas is that Bitcoin, as an example, has had a big correlation to kind of a risk on market, and that really hasn't been the case as of late. Bitcoin's has been really kind of lagging in performance relative to the rest of the market. So we've got kind of a big chunk of the markets moving higher, and then you have these assets that are normally a risk-on asset, kind of trading on a risk-off basis. So again, is there these things typically have a rotation at some point, and money will start to look for some of these kind of oversold, kind of beaten up sectors as kind of the next trade. So, kind of the trades move through the market. So again, this is why if you're in a really hot asset of the markets are doing great, you're making a lot of money, don't forget to take risk because eventually that rotation will occur. When it occurs, who knows what causes it. That's just how markets work over time. Anyway, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk all about the Fed yesterday, what they said, what it means for the markets. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Michael Lebowitz joining me as well. Got a lot of stuff to get into. Yesterday, of course, the Fed had their big meeting. The big meeting. Everybody was all excited about this. Everybody's always just ramped up for these meetings. It was really kind of boring, actually. So, Mike, what was your takeaway from it yesterday?
It was boring. They kind of did what we thought they would do. They didn't cut rates. They didn't allude to rate cuts at the next meeting or two. The general gist of it was that Powell is optimistic that this recent, called an uptick in inflation, even though it's just more kind of getting stuck at a higher level, is because of tariffs, that we're at the peak impact of tariffs and that should start coming down. He made a quote somewhere in there that he thinks CPI less the impact of tariffs is around 2%. So I think what he's kind of telling you is that when we get rid of this tariff impact, which should be now, I think some of it has already started happening and some of it will happen, that the inflation will finally start coming down to 2%. We've been talking about Truflation. Truflation is plummeting. So maybe it's capturing some of that even earlier. So that's the good news. The other good news is on the labor front. They changed their description of the labor market a little, so it's not as weak as it was the last time, based on evidence they're seeing. So that evidence is not ADP, it's not BLS, it must be their private sources, because all the public sources that we see continue to point to a weak labor market. I also think, Lance, that, look, Atlanta Fed GDP is hovering around 5. We just had 4% economic growth. It's very hard to have a weak labor market if growth is truly that strong. So I think that's having some impact on their outlook for labor, and they're not worrying about it as much. And, at the end of the day, where that gets them is that rates are in the right place, give or take a little.
But again, this is going to be kind of one of the interesting things. If you take a look at, again, like the Atlanta Fed GDP now, even the New York Fed. So if you take there's two different Fed agencies out there that put out these kind of growth estimates, and I'm talking to our audience, not you, Mike. There's the Atlanta Fed GDP, which they have a way that they calculate kind of based on real-time data inputs, kind of where GDP is. And right now they're closer to 4% than kind of the 2% economic growth rate. The New York Fed does the same thing, but they're about 2.73. So they just calculate it differently, but you kind of get this disparity of estimates for what GDP growth is. But what's interesting is that GDP growth is very strong right now. So we're seeing very strong economic growth here in the U.S., and you can kind of debate that for what you want, but that's just what the data says. A lot of that has to do with net exports, of what's happening because of these tariffs has created this kind of input into net exports that's influencing the GDP output. So if you strip that out, GDP is a lot weaker, but we have to calculate GDP for what it is. So we just have to understand that that's the number we're going to be working with. But Mike, what's interesting about that is that you have GDP growth and the Fed's like, okay, it's a tariff impact and now tariffs are going to come back down to lower levels. The problem with that, though, is that if economic growth is as strong as the headline suggests, that is typically going to lead to some inflationary pressures. Now, lay on top of that the rising prices of inputs like silver, as a good example, which is an input into the economy, and oil prices have been on a tear now. We're above $70 a barrel. We were at nearing 50. We were at the low 60s just a couple of weeks ago. Oil prices have been on a tear. Now that's about a 3-month lag into the input, but there's a very high correlation because of energy and oil prices being such a big input into everything that we consume and use and drive and everything else. There's a very high correlation between rising oil prices and inflationary pressures. So we could see inflation tick up here, between now and the next meeting or for the Fed, or the next two meetings for the Fed, that may put the Fed back on their heels even further.
So Powell made an interesting comment towards the end, and the reporter said, we get that it appears that you're more likely to cut rates, but is there a chance that the next rate change is actually a rate increase? And when I heard the question, I said, well, he's going to say, we don't know what the future holds. And while we think it's a rate cut, we could be increasing rates. He didn't go that far. He said it's very highly likely that they increase rates anytime soon. And
wait, it's very highly unlikely.
Unlikely, I'm sorry.
Yeah.
that they increase rates anytime soon. And he kind of still put the odds toward, even though he said they're less likely to cut now than they were last time or 2 times ago, the odds are still that they're going to cut rates. He still thinks it's restrictive, just not as restrictive. Now we're talking about various shades of restrictiveness.
Right.
So something tells me that they don't believe this recent spurt of growth is look, it's not sustainable. The natural growth rate of this country is it's under 2%. So they're kind of banking that this is just tariff related, a little bit of AI in there, which is not necessarily adding too much to kind of inflationary pressures other than certain small sectors. So, I think they're banking that the inflation will come down. Remember, you also have, once the tariff effect goes, you have very low inflation rates in many of these goods. Housing is all but assured to come down, and that's 40% of inflation. So the Fed is banking that even if growth is a little bit stronger, inflation is coming down. It's funny, but their bigger risk may be that the labor market starts really getting back into high gear. And that is what could cause the Fed to go, because as long as labor's weak, I feel like inflation should be somewhat tame because you don't have salaries chasing demand, pushing demand.
Right.
But if we get a big increase in employment and we start to see that the things like the quits rate is rising, so people are confident they can get a higher paying job, like what we saw a few years ago, that may change the Fed's view that inflation is going to accompany this uptick in growth.
Yeah, no, and look, wage growth has been slowing for sure. And take a look at like the Atlanta Fed wage tracker; it's declining. But again, if you start getting a kind of an increase in the labor market, if we start to actually see this economic growth translate into actual employment, where we're starting to see stronger employment rates, those type of things, that's going to start to turn wages higher. And higher wage growth is an inflationary input. So, it seems like the Fed's, probably in a good place right now, but I think there's certainly some factors that are occurring that we could see feed into the CPI calculation, so to speak, where we start seeing some prints that are hotter than expected over the next several months, just from the very inputs of what we see going on, particularly in the commodities market. Copper prices are up. We're seeing, like I said, inputs like silver up that go actually into uses in the industrial economy. If that that will start to get passed through to consumers, and we're going to start seeing higher prices on electronics and those type of things, vehicles, et cetera, seeing higher prices there, that should start to feed into CPI. Again, we're not talking about, by the way, just be clear, we're not talking about CPI going to 9%. We're just talking about CPI printing at 0.3 or 0.4 versus the estimates of 0.2.
Right. But on the flip side, we know food prices are coming down pretty quickly. And we know, again, the big bugaboo is the 40% housing shelter is coming down. Whereas silver, copper, they all play a very minor role in the production of these goods. I mean, it's not a huge cost when you're making a TV or another electronic good. It will increase costs, but it's such a smaller percentage. So,
Well, that's what I'm saying. Is like, I'm not saying that we're going to have this big runaway spike in inflation, but what I am saying is that we could see some pressure on inflation that could keep. Right now, I think as we left it yesterday after the meeting, I think the estimates were for 2 more rate cuts this year, as of the last check. But maybe we see a year where we don't get any more rate cuts this year, and of course that could potentially weigh on markets because the markets have been so kind of focused on more accommodative policy from the Fed to help support valuations where they are.
True. And speaking of valuations, the other thing, the Fed didn't, at least I didn't hear it, didn't mention QT.
Right.
So the last few meetings, they got rid of QT. They started QE in December. Liquidity was an issue. They were talking about liquidity. They didn't mention anything. So that tells me that liquidity is back to at least an ample state, which on the margin is good for risk assets. We talked about this a while ago. What's interesting is that QE and Bitcoin have a very high correlation. And we've seen Bitcoin, you talked about it earlier, Bitcoin languishing. So it'll be interesting to see if Bitcoin can start heading up again as QE starts accumulating in the system.
So did they? But you said they didn't mention it all, but just for perspective, we were doing about $40 billion a month in kind of short bill duration. They didn't make any change to that, so that's still going on as well.
Right. Yeah. But they didn't. There were no extra comments about it.
Got it.
It was just this business as usual.
Got it.
Which is, when they're in the middle of QE and they don't see a need to change it, that's usually the way it is. But we've seen repo rates have steadied. There's nothing irregular going on in the overnight borrowing lending markets. So we have to assume liquidity is back up to a reasonable state. If not, maybe slightly heightened based on what we're seeing in some of the metals and some other areas.
Yeah, well, and again, we're just seeing, and as I was talking about this morning, I thought this was interesting, just talking about what's going on with, kind of the metals in general as of late. And you remember back in 2022, or sorry, in 2020, 2021, that we had this very big surge in, kind of retail appetite for kind of chasing meme stocks and those type of things. And I thought this was interesting. Citadel Securities published out this morning this is their retail risk on, risk off indicator. And what's interesting about this is that there's a very good correlation between this and kind of what happens in the markets. And right now that indicator's basically pegged at 99%. So it's the most risk on kind of attitude, by retail investors that we've seen. Now, if you don't understand who Citadel is, by the way, Citadel is a massive hedge fund, and they are the ones that clear all the trades for Robinhood. So in other words, when you trade on Robinhood bundles your orders and sells them to Citadel Securities, who then executes on the other side. So they're arbitraging all these trades that happen off Robinhood, but that's how they can track retail traders, because that's who trades on Robinhood, and they clear all the trades for Robinhood.
And that's why Robinhood trades are quote unquote free.
That's correct, right? Yeah, it's payment for order flow that we've talked about before. Robinhood bundles the trades; they sell those trades they sell that quote unquote order flow to Citadel, who pays them for that order flow. Then Citadel goes, okay, great, I've got 500,000 orders here for ABC stock or whatever, and they can go on the other side and they can arbitrage that trade, and that's how Citadel makes money. So it's there is no free in the market. You're paying for it one way or the other, but it's just the way the markets work these days. But the point is that they have a very good insight into what retail investors are doing, and I just thought it was interesting because we haven't seen this level of speculative activity by retail investors since really 2021. So it's a very similar type situation. And margin debt, as an example, and I was talking about that, kind of earlier, that margin debt level that we've got going on has had just a very, very sharp increase. Here's a chart. This is the 8-month rate of change I was addressing earlier in margin debt, which is now at one of the highest levels. There's only been 3 other periods that margin debt, the 8-month rate of change of margin debt has been at this level. That was in 1999. That was again in 2007, and then in 2021. Just putting it out there for you. So just something to think about. Go ahead, Mike.
No, I mean, it's we talked about this in my article, whenever that was, a week or two ago. We've been in this consistent, we call them mini bubbles. These mini bubbles that inflate and deflate, but they're not big enough to really become a financial crisis, a dot-com bubble, some of these other nifty 50 bubbles, those bubbles. But it just shows that investors are just moving from one speculative asset to the other. Gold and silver are in vogue today. And look, maybe silver's going to 400 because I'm tired of people telling me that, I'm wrong. But it has all the signs, just like all these meme bubbles, SPAC bubbles, go on and on. Similar signs. It's just, gross speculation by the public. Well, and then institutions follow on, and it can build on itself pretty quickly.
Well, and that's the thing about leverage, right? So when you talk about margin debt, don't panic over margin. It's like, oh my gosh, Lance showed me a chart this morning that margin debt was at the highest level since these other previous kind of market tops. First of all, margin debt can stay there for a while, and again, when you're spiking up in any asset, it can stay that way for months. So again, it's not something you act on immediately and by any stretch of the imagination. And besides that, rising margin debt is bullish for the market because that's more buying power for the market. So again, as margin debt goes up, that's more buying power, that's more money getting invested into assets. But the risk there is, of course, is the reversal because margin debt works in reverse. And so when you have to start deleveraging, it also fuels the downside in the market. So again, it's not something you panic over. It's not something that you go, oh my gosh, I'm going to sell everything today and get out of the markets because the market's going to crash. That's not saying that at all. But it's a symbiotic relationship between margin debt and outcomes of markets, depending on which way it's going. And so it's at least something worth paying attention to, because if that margin debt level does start to reverse, that rate of change starts to reverse, in other words, people are deleveraging, then that is going to weigh on market returns in various asset classes. Whatever the leveraged assets are, those are the ones that are going to hit the hardest. So it's just something to consider.
But Lance, this is why we always have to talk about the Fed. Why it's always become the number one topic in finance, because they are the provider of liquidity to the banks, which allow ultimately the banks to make margin loans, among other things. So the Fed's doing QE now, so they're adding liquidity. They're making margin loans more accessible right now.
Right.
It's not a huge amount, but on the margin, margin loans, margin are more accessible than they were a month or two ago.
Yeah.
So just something to keep in the back of your head.
Yeah, and again, this is why we're seeing margin debt as of the December numbers, which just got published yesterday from FINRA. Margin debt just passed 1.3 trillion. So there is a lot of margin debt sitting out there. And again, there's we've showed you charts before. Margin debt versus disposable personal incomes is at all-time highs. Margin debt as a function of monetary supply, M2, is at an all-time high. So again, there's just a lot of leverage in the system. And again, it's bullish. It's very bullish for the markets. More leverage is out there, the better. That's higher, means higher prices, more money coming in. You just have to be aware of the other side of that. And again, we're not suggesting anything that the markets are about to crash, but it's just it's the fuel, as we talked about before. It's the fuel for a reversion when you get there. And again, I can have a gas can sitting on the ground and it's fine. Just don't drop a match in it, right? And so it's just you have to have a catalyst. And right now there is seemingly no catalyst for the markets. But that's the problem, is that eventually a catalyst will show up. What that is, I have no idea. But some catalyst will eventually show up that causes market to reverse. Because again, markets are very optimistic, really across the board. Optimistic. Earnings expectations are extremely optimistic. Investors are willing to pay high valuations right now because they're convinced that markets can only go up, and that all these expectations we have on earnings are going to come to fruition, which makes current valuations justifiable. That's the risk, is that we've got a very complacent market. And again, there's nothing wrong with that. That doesn't mean anything. In the near term, it keeps bullish markets bullish, but that complacency is also a risk.
I would also just add to that, liquidity shifts. So, we went through periods where Bitcoin was in vogue and gold and silver weren't. Now we got the opposite. So the liquidity may stay out there, but for some reason, we may see shifting liquidity, going from metals back to Bitcoin, going from high beta to low beta. These are all the sector rotations, asset rotations that we talk about. So it's not just the amount of liquidity, but where it's shifting to and from. That is equally important to follow.
Yeah. Well, and again, there's a lot of international stuff, geopolitical stuff going on right now. We've got rising tensions, here with Iran again, and we've got policy coming out of the government on different fronts. And so all these things, and most importantly, we've got midterm elections coming up this year. So in the next few months, we're going to start getting kind of really into all of the political campaign season for midterm elections. that, certainly a change in control of the House or Senate can provide a very different outlook for what policy is going to be, what geopolitical policy is going to be going forward. I mean, we could get into a position of very much a stalemate within the House and the Senate, which basically means that everybody becomes a lame duck at that point until the next election. And also, too, we're running the risk right now that as of Sunday, we might be back into a government shutdown by Sunday over DHS funding. The Democrats are holding the hard line right now on funding for DHS because of this whole kind of immigration issue that's going on in the country right now, or the deportation issue going on right now, in particular, particularly in Minneapolis, which has been filling headlines as of late. But that is potentially another risk that we run going into next week. Now, shutdowns typically don't impact markets much, but it's certainly it's certainly one of those things that can provide some volatility, in these type of markets.
And given how close we are to the midterms, this shutdown could get uglier and more headline producing.
Right.
So typically we don't really concern ourselves with these, and I'm not overly concerned with this one either, but this one has potentially a little more risk than we've seen in the past. I'm not saying the market's going to fall apart over it, but it's just, it could extend. I saw the TGA, so that's the Treasury account at the Fed, is almost up to $1 trillion. So they're creating this war chest of money that they can spend even when the government shuts down to some degree. So, maybe they're bracing for a long shutdown. We'll see. Not a chief concern, but again, it is something that can weigh on markets at times.
Right. Well, and again, just as we kind of just think about where things are headed, and again where the Fed's headed in particular, because again, a lot of this is just a function that markets are very dependent on liquidity and monetary policy, and when markets are highly leveraged and stretched, those type of things, changes to monetary policy, or certainty at least in terms of monetary policy, is going to be really kind of the thing to watch. We saw this back coming out of 2022. We had that decline going on in the markets following the 2021 run. And we saw those big rallies in the markets because the expectation was, okay, the Fed's going to stop hiking rates and there's going to be a favorable change to monetary policy, and markets would rally into the meeting, and then Jerome Powell would say, nope, no change, and the markets would sell off again. And we just kind of stair-step down, all through 2022 before we got into October of that year, and then things started to kind of stabilize on the Fed policy front. But since then, we've seen that same type of action, is that the markets have been so focused on what's Powell going to say, what's the Fed going to say, what's going to happen next, that we may be shifting into an area where that policy directive becomes much more uncertain because of what's happening between economic growth, potential upticks in inflation, whatever. That may become a lot more uncertain for the markets, which could also be a headwind.
Yeah. Yeah, I mean, look, bottom line, between now and the election and probably after the election, there's a ton of headline. It's not necessarily risk. It can go both ways, because Trump is very incented to get this economy going fast, get the stock market up, so we could and help on the affordability issue. So there's volatility risk, volatility going up, and markets going up and down, kind of as we get towards the midterm elections in November.
Right. So outside of that, we've kind of talked, recently about a few different things, kind of in different articles. You just wrote an article recently, kind of discussing the AI bubble, I guess is the best way to put it. But, kind of what are the things that you're looking at most closely right now? So this article I wrote was actually kind of interesting. The question is, are we in an AI bubble or not? And back in 2002, this woman, Carlota Perez, wrote a book, Technological Revolutions and Financial Capital. And she looks at the long history of technology, especially new, very productive technologies like AI, and the financial capital, how capital kind of gravitates around it. And she comes to a very clean point. The point is that when we get these huge technological changes, investors
price in the future. That's what we do. We discount future cash flows, whether it's a simple loan or bond, or whether it's a stock, or whatever it may be. You're buying a bar, you're buying a supermarket, you're discounting future cash flows. The discounting rate is not hard to calculate. What's hard to calculate in some instances is the future cash flows. So what happens is when you have these technological innovations, you get high in the sky forecasts of what it's going to be. And in reality, we don't know what AI is going to look like 5 years from now. But every company has painted a picture of all the amazing things AI is going to do. So as investors, and this happens over and over and over and over again, we discount those pie in the sky cash flows. Inevitably, pie in the sky is not where the innovation led us. It was somewhere else. It could still be equally great or even greater for the economy, but it wasn't this company or that company that got us there. A great example is Yahoo. You know, if you, in the article, let me find it here real quick. In the article, I list the top search engines in order in 1999. Yahoo, Alta Vista, Lycos, Excite, MSN Search, remember Ask Jeeves, and AOL. The only one that I know that, well, I guess Yahoo and AOL are still around right now. I'm sure the other ones maybe.
I still get the occasional email from somebody that has an AOL address on it.
Right, which I like because it makes me feel not as old. Because I have a Yahoo address on my personal, and the kids are always getting on me about that.
Yeah.
But right now, Yahoo has a market share of about 1.5%. What do we, Lance? If I want to see what time the movie is playing today, what do? I go Google it, right? That's the word for search. It's Google, right? They've done an amazing job that it's not even called, I'm going to go look at my search engine. I'm going to Google to see what time the movie's playing, even if you're not even using Google. And Google is 90% of the search engine market. Google didn't even come around till they were very unknown in 1999 when the dot-com bubble crashed. They started coming around in 2004. And the point is that we don't know what technologies will best take advantage of this innovation. Turns out that Google was one of those companies. Meta was one of those companies that were very different back in 99. So, you know, the bottom line is we don't know what the future holds, and the market is acting like it does. Inevitably, the future holds something different, and we will see how it works out. But her book is fascinating, and it just goes through history and explains why this happens over and over again. And the article, I kind of talk about how this relates to AI. I share quite a few quotes. I end each section with a quote of hers that pertains to it. So it's worth, I'm not sure I'm going to say you should read the book, but read my article. It's the Cliff Notes, or the Cliff Notes as it applies to AI.
The short version of AI. But it is very interesting, though, because, again, there's a lot of concern. Look, there's a market capitalization issue, right? So everybody looks at the market and they say, look how, we've got this massive market capitalization issue. A handful of stocks make up 40% of the entire index, which is an issue. Every dollar that goes into a VOO or an SPY, 40 cents of that goes into, 10 stocks. So the market capitalization risk is certainly something that is out there. But again, we've got a very different economy today than we've had over the past, really even going into 1999. You didn't have these companies that are making up the large share of the markets, which we had the same type of market capitalization concentration back in 99, 2000 as well. But the difference this time is these companies just print an enormous amount of money. Very profitable, lots of revenue. And even though they're spending money on building out data centers, most of that's coming out of free cash flow. And yes, they're taking on debt, but that debt is minimal, relative to these companies.
Yeah, let me just read a quick quote of hers regarding that market concentration, because that is a thing that's been recurring. During a speculative frenzy, financial capital tends to concentrate on a few apparent winners, creating the illusion of permanence long before the competitive landscape has stabilized. So we don't know how AI innovation will ultimately work out, but the market is betting on a few horses. Those horses today are the Magnificent Seven and a few others. Inevitably, some of those seven will be winners. The potential is that some of them were just chasing AI in the wrong direction. And the other inevitability is that there are companies that are maybe small, that are private, or that haven't even been started yet, that will look back in 20 years and say they won the AI race, just like Google. So, what she kind of says is you get a frenzy, the bubble pops, the innovation, AI, the innovation of AI is not a bubble. That's for real. But the financial bubble collapses, and then you get a more constructive capital spending because we know more what AI is and what it can do at that point. So if you missed out on this AI boom, don't worry, because what Carlotta Perez says at least is after we get this burst, the true winners will emerge, and you can bet on the Googles in the 2004 Googles that have kicked off 25% a year for 20 odd years.
But maybe that's the interesting thing, right? Is that if you go back to 1999, 2000, right, in the heat of the moment, and I remember these days clearly because we were trading right in the middle of it. The SDLIs, the JDS Uniphases, the Global Crossings, those type of stocks were going crazy. But a lot of those companies, when the eventual downturn came, they got impacted, by the downturn. Of course, all the companies, Apple lost 80% of its value, and we saw that all across the board. But a lot of those companies had no revenue growth. They had no earnings. And so, you can almost look at the companies today and go, this bubble, whatever it is, eventually pops. But you kind of already know who the winners are going to be because they already have the revenue. It's not like you're betting on future revenue growth. They've already got the revenue growth, right?
Well, they've made money, but let's look at NVIDIA.
Sure.
Right? The price of NVIDIA is still predicated on years of enormous earnings and revenue growth.
Sure.
Let's just say that AI technology makes an abrupt change tomorrow and their chips are worthless. There's a new company called the Lance and Mike Chip Company
which you can invest in right now. We're taking donations. Go ahead.
that the Lance and LMC, the Lance and Mike Chip Company, that it turns out when we look back 20 years from now, their chips were the chips that were needed. Right? So the price of NVIDIA in that case would collapse, not because they've made a ton of money already, but the discounting of all those future cash flows just shrunk significantly.
Right.
So the point is, yes, they've made money, and in general, they're not borrowing heavily. So it's very different than the dot-com bubble. But again, we don't know at this point who the winners will be. And look, it could be Microsoft, Meta, NVIDIA. It could be the company. It's that, maybe this time is different. I'm not saying it's not.
Well, I'm not saying that this time is different, and but for instance, let's say the LMC company is out here making a fantastic chip. NVIDIA is probably going to buy us for some obscenely large amount of money, and we're both going to retire and go to the beach. But now NVIDIA just did this recently. They just one of the kind of changes to the environment were TPUs, which are these different types of CPUs that have a direct translation of memory of data, kind of through the system. And NVIDIA, which Google's leading that TPU development, NVIDIA just went and bought a company to develop TPUs. Right. So, this is kind of the point, is that NVIDIA will probably be on the other side of this, will probably still be in the lead of the pack, because what they can't develop, they're going to go acquire it and bring it in. Because they're very dynamic with the markets. As markets are changing, they're making changes with the markets because they're developing what people need.
I agree 100%.
Yeah.
But the TPU market is a lot more competitive.
Sure.
So the margins are slimmer.
Sure.
Again, those future cash flows get impacted.
Yeah.
I'm not saying NVIDIA won't be the winner. That was just, that's the
No,
example.
I'm just all I'm saying is that I'm just trying to make the point that the difference this time, and I'm not saying this time is different. We're not going to have another 1999 2000.com blow up.
Right.
I'm not saying that at all, because it's very possible. But what I am saying is that it seems to me that the winners are a little bit more obvious this time. Who's going to survive this? In other words, who's going to be on the other side of whatever correction comes? Are much more obvious today than it was in 1999. Everybody thought Global Crossing, even Jim Cramer, right? These 10 stocks are going to be the best winners over the next decade. This is March of 2000. Global Crossing's on his list. 9 of the 10 were bankrupt or went out of business or were sold off within a year. So, it's a very different environment. I think today it's easier to pick the winners that are going to be there. Doesn't mean they're not going to suffer big price declines, but you can make much safer bets this time around than you could back in 1999.
And I do think that's true. But I think her book is really important. Just give the article a read and understand how capital kind of, this feeds in with what we were talking about earlier, with the chase for the metals and the chase for all these bubbles. Capital wants to hear the best news possible, the best outlooks, and they price in those outlooks. And it's just an amazing, when you really go back to the railroads and, all these other bubbles, you had the railroads, turns out the railroads were pretty successful, right?
Yep.
It really made this country, but a lot of those original railroad companies failed. A lot of the original electricity companies failed. The search engines failed. I'm not,
Yeah. No, it's a valid point.
Just the dynamics are fascinating.
Yep.
How this one plays out, we'll find out.
Stay tuned.
Stay tuned. We'll be back in 20 years.
Exactly. It may not be 20 years. We may see it sooner than later. All right, that wraps up the show for the day. Thanks for joining us. Be sure and give us that thumbs up on the video channel day. It certainly helps us with the algorithms. We appreciate it very much. Also, get by the website. Mike's latest article is on the website now, realinvestmentadvice.com. This weekend's newsletter, we're going to be addressing the extinction of bears. Bears have been now added to the endangered species list. We'll be going through that this weekend in the newsletter, so make sure you're subscribed at the website. We'll get that email directly to you Saturday morning. Has all of our technical analysis, sector market rotation stuff in there as well. So kind of a good overview, get you set up for the next week of how the market ended and what to start looking for next week. That's all in this weekend's newsletter. It's on the website now, realinvestmentadvice.com. Subscribe there, and we'll have it out to you on Saturday. All right, y'all have a great day. See y'all back here tomorrow for Financial Fitness Friday. Have a great weekend.